Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, when you picture Warren Buffett, you probably think of the guy we see today. The wise, patient Oracle of Omaha, sipping a Coke, talking about holding great companies forever. But the thing is, that's not how he started. The real question, the one that's way more interesting, is how did a young, hungry, ambitious Buffett make his first millions back in his 20s and 30s? Well, I'll tell you this much. It wasn't by buying wonderful companies. It was a much grittier, more aggressive, and frankly, a much more exciting game that laid the groundwork for everything that came later. So here's what we're going to do. We're opening up the secret case files of young Warren Buffett. First, we'll get inside his head and understand his cigar butt philosophy. Then we're diving into 3 key cases: a ridiculously boring barrel maker, a dying coal company he decided to take over, and a massive scandal that almost destroyed a financial giant. And finally, we'll put it all together and uncover the 4 pillars that really explain how he did it. Let's get started. All right, first up, the cigar butt investor. See, long before Buffett was searching for wonderful companies, he was a completely different animal. He was a scrapper. He spent his time digging through the market's trash heap, looking for broken, ugly, unloved businesses that nobody else would touch. He was looking for, as he called them, cigar butts. I love this quote because it's so perfectly him. It's a little gross, sure, but the logic is brilliant. What he's saying is, find a lousy company that's so incredibly cheap, it's like finding a cigar on the ground that someone's thrown away. It's got 1 puff left in it. Now, since you found it for free, that one final puff is pure, 100% profit. It's not about loving this cigar or wanting to smoke it forever. It's about getting that last guaranteed puff for nothing. That's the game. Okay, let's crack open our first case file. Greif Bros Cooperage, a barrel maker. I know, it sounds unbelievably boring, right? And it was. The whole industry was shrinking. But Buffett realized that hidden inside this snooze fest of a company was a treasure chest. And he found it by doing the tedious, number-crunching work that no one else on Wall Street could be bothered with. So what was his secret weapon? It was this concept he learned from his mentor, Ben Graham, called net current asset value. It sounds complicated, but it's actually super simple. You just take all the stuff the company could sell off quickly, cash, inventory, stuff like that, and then you subtract every single dollar the company owes to anyone, both short and long-term debt, all of it. What's left over is the company's absolute rock-bottom liquidation price. And what did Buffett find? Greif Bros was selling for less than that price. It was like buying a wallet for $5 and finding a $10 bill inside. And this is where it gets just wild. Look at this balance sheet from back in the day. A massive chunk of the company's value was just cold, hard cash and U.S. government bonds. You literally can't get any safer than that. The stock was trading so cheaply that after you bought it, the cash alone was worth more than you paid. That means you were essentially being handed all of its factories and valuable land for less than zero. They were paying you to take the business. It's just an absolutely unbelievable deal he found by just reading the fine print. And you don't have to take my word for it. This is what he wrote to his hero, Ben Graham, about the deal. Talk about an understatement. This wasn't some wild guess about the future of the barrel business. This was pure math. It was a no-brainer. The value was sitting right there in black and white, and he was the one who bothered to look. It was the perfect cigar butt. All right, on to our second case file, and this is where we see Buffett evolve. He's not just finding cheap stocks anymore. Now he's starting to get his hands dirty. With the Philadelphia and Reading Coal and Iron Company, he's not just finding the cigar butt on the street. He's grabbing it, lighting it himself, and forcing it to give up that last puff of profit. He's becoming an activist. So how did they pull it off? It was a classic activist raid. First, they quietly bought up a massive chunk of the stock, almost a third of the entire company. Then they teamed up with other angry shareholders to get even more power. With that leverage, they forced their way onto the board of directors. And once they were inside, they didn't just suggest changes, they demanded a whole new strategy. They weren't waiting around for the value to unlock itself, they brought the sledgehammer. And just like before, the clues were hiding in plain sight, right here on the balance sheet. The company was sitting on a mountain of assets, especially cash, that was tied up in inventory and didn't need. The plan was just brilliant. Step 1, sell off all that extra inventory to raise a ton of cash. Step 2, use that cash to buy other really profitable companies. But here's the real genius move. Because the coal business had lost so much money over the years, it had these huge tax losses. That meant they could buy a company making millions in profit and use the old coal company's losses to pay zero taxes. It was a financial masterstroke. And boy, did they transform this thing. The first thing they did, they literally dropped coal and iron from the name. Then they went on a shopping spree. They bought Union Underwear. Yep, the fruit of the loom guys. They bought a clothing company, a toy company. They took this dying industrial fossil and turned it into a modern money-making machine. It just goes to show you, sometimes you have to make your own luck. Okay, our final case file. This is the big one. It's got fraud, it's got panic, it's got Wall Street in a meltdown. But more importantly, this is the moment that changes everything for Buffett. This is where he makes the leap from just being a numbers guy to understanding the incredible, almost magical power of a great brand. And it all started with a scandal that nearly destroyed American Express. The story is so crazy you couldn't make it up. It's called the Great Salad Oil Swindle. Basically, this con artist borrowed a fortune from banks using salad oil as collateral, and American Express's warehouse division was the one that certified it. They told the banks, yep, the oil is here in these giant tanks. The only problem? The tanks were actually filled with seawater. There was just a tiny layer of oil floating on top to fool the inspectors. When the whole thing blew up, it looked like Amex was on the hook for all of it. And the market? Well, the market just completely lost its mind. You can see it right here. The stock price didn't just fall, it got cut in half. Total sheer panic. Wall Street was convinced the company was going bankrupt. And to make it even scarier, Amex had this weird old structure where shareholders could actually be on the hook personally for the company's debts. People thought they could lose everything. So in the middle of all this chaos, while everyone is screaming and running for the exits, Buffett sees the investment of a lifetime. Which brings us to the big question. What in the world gave him the courage to bet 40%, 40, of all his partner's money on this one stock that everyone else was convinced was radioactive? The answer is, he did what no one else on Wall Street was doing. He got out of his office, he became a detective. Real, old school, boots on the ground research. He went around to restaurants and banks and travel agents in his hometown, and he just watched and listened. He asked clerks, hey, are people still using American Express traveler's checks? Are they still using the cards? And the answer he got back over and over was a resounding yes. He realized the scandal was a Wall Street story. For real people, the American Express name was still solid gold. The company's most important asset, its reputation, was completely untouched. So let's step back. We've gone through the case files, the barrel maker, the coal company, the salad oil swindle. When you put all the evidence together, a really clear picture emerges. The verdict on how young Buffett pulled off these incredible returns really comes down to 4 key pillars. Here they are. Pillar 1, activism. He wasn't just a passenger. He grabbed the steering wheel and forced the company to change. Pillar 2, concentration. I mean, when he found an idea he loved, he bet the farm. No little bets. Pillar 3, Gumshoe research. He just flat out outworked everybody, hitting the pavement to find information you could never find in a report. And finally, Pillar 4, a discerning filter. This is the big one. He knew when to just focus on the cold hard numbers and when to look beyond them and bet on an untouchable brand. And if you want to see what that concentration looks like, just check this out. This chart is from 1951. A single company, Geico, made up more than half of his entire net worth. Think about that for a sec. Today, financial advisors tell you to own hundreds of stocks. He basically owned one. It's the definition of putting your money where your mouth is. And this quote really sums up the whole journey. He started out as a pure numbers guy, a cigar butt scavenger. But the American Express deal was the thing that taught him this lesson. It proved that making a quick buck on a cheap stock is one thing, but the really life-changing, empire-building money comes from being right about the big picture, about finding a truly great business. This was the moment he started to become the Warren Buffett we know today. So I'll leave you with this final thought to chew on. Today's market is all about growth, right? The next big thing, the next world-changing technology. So is that old-school cigar butt approach of buying ugly, cheap, broken businesses totally dead? Or, and this is what I wonder, has our obsession with the new and shiny thing created a whole new scrapyard of forgotten, overlooked companies just sitting there, waiting for someone to come along and find that one last free puff?
You hear the name Warren Buffett, and you probably think master investor, right? The Oracle of Omaha. But we're not talking about his greatest hits today. We're going to look at one of his very first investments, a company that was a total flop for him, but taught him a lesson that would literally shape his entire career. This is the story of a company called Marshall Wells. Just listen to this. Imagine someone saying this about the man who would become one of the wealthiest people on the planet. This is what an established investor, a guy named Louis Green, actually said about a young Warren Buffett back in 1956. I mean, talk about a brutal takedown. It just perfectly sums up how the world saw him then. He was just some kid. But let's rewind a few years, back to 1950. That kid was a 20-year-old grad student who decided to take a huge swing on a company that, let's be honest, almost no one remembers today. And this is the story of that bet, and the billion-dollar lesson it taught him.
All right, so first, let's really set the stage. Who was this investor before he became, a legend?
So back in 1950, you've got Buffett studying at Columbia under his absolute hero, the father of value investing himself, Benjamin Graham. And he wasn't just hitting the books, he was putting his actual money on the line. He took $2,500 and plowed it into Marshall Wells. Now, that might not sound like a fortune, but for a 20-year-old student, it was a massive commitment. Think about this. It was about a quarter of his entire net worth at the time. He was so all in that he actually skipped class to travel to the company's annual meeting just to see for himself what was really going on. So what was this company that had him so hooked? This wasn't some tiny, speculative little business. Oh, no. Just take a look at this map. I mean, wow. This was their turf. They called themselves the hardware merchant to a continent. And they weren't just blowing smoke. Their reach was insane, stretching from Minnesota all the way across the Canadian West and right up into Alaska. It was a true empire, all built on hardware.
Yeah, Marshall Wells was an absolute behemoth in its day, the largest hardware wholesaler in all of North America. They were so big, in fact, that by 1955 they made the very first Fortune 500 list. And they had a really smart business model, running this program where independent hardware stores could use the Marshall Wells name. It created this huge, loyal customer base.
Okay, so you've got this massive, successful company. So why on earth was a young, scrappy value investor like Buffett even looking at it? Well, this is where it gets really good. What did a 20-year-old Buffett see that pretty much everyone else was missing?
Let's look at the numbers, because this is exactly what Buffett, the student of Ben Graham, was seeing. The stock was trading for just 60% of its net current asset value. Its enterprise value was less than 2 times its operating earnings. Look, forget the jargon for a second. All that means is that this company was dirt cheap. I mean, ridiculously, mind-bogglingly cheap on paper.
Now, to really get why this was such a big deal, we got to talk about this one key concept: net current asset value, or NCAV. Just think of it like this. It's the company's fire sale value. If Marshall Wells decided to just shut its doors tomorrow, pay off every single penny it owed, and sell off all the easy-to-sell stuff like its cash and inventory, the NCAV is the pile of money that would be left over for shareholders.
And here's the thing that made it seem like such a sure bet. Over 80% of the company's assets were current assets. We're not talking about some fuzzy brand value or old factories here. We're talking about tangible stuff. Cold, hard cash, government bonds, and stacks of inventory. The value was real. You could almost touch it. So let's put it all together. Here's the bottom line. Buffett paid $200 for a share of this company, but its fire sale value, that NCAV we were just talking about, was more than $331 per share. He was literally buying $1 for 60 cents. On paper, it was the definition of a can't-lose investment. Or was it? So you've got a textbook Ben Graham stock. A total slam dunk. What could possibly go wrong? Well, this is why this story is so fascinating. This is the twist. He sold. Just like that. In the very same year he bought in, 1950, Buffett dumped his entire position. And get this, he didn't even break even. He actually took a small loss of about 1% on the trade. Why on earth would he do that? He had found the perfect statistical bargain. What happened?
The answer wasn't on a balance sheet. It was in a boardroom. Remember that annual meeting he skipped class to attend? He walked away totally underwhelmed. He said the management had a lackadaisical approach toward its owners, the shareholders. To him, they were just going through the motions, treating it like some legal chore instead of a moment of accountability. For a guy like Buffett, who thinks of shareholders as partners, that was a massive red flag. The people running the show just didn't seem to care. That, plus finding some other opportunities, was all he needed to see. He got out. And you know what? His gut feeling, that sense he got in that meeting, it turned out to be dead right.
Let's take a look at what happened to this hardware giant after Buffett walked away. See, the business world was changing, and Marshall Wells was just stuck in the past. Its old-school model, with huge overhead costs and expensive traveling salesmen, was just clunky and inefficient. And at the same time, you had all these new, nimble competitors popping up, leaner models like dealer-owned co-ops that could do the same job for a lot less money.
And you can see the story of that decay right here in their own numbers. After a quick bump from the Korean War, just look at what happens to their profit margins and their return on capital. From 1952 on, it is just a slow, steady bleed. The business itself was rotting from the inside out, and no amount of cheap assets on the books could stop it.
From there, the end came pretty fast. In '55, the founding family cashed out and sold control. By '57, the new owners were already starting to liquidate parts of the business. The recession in '58 was the final nail in the coffin, and the company was just carved up and sold for parts. Just 9 years after Buffett made his bet, the hardware merchant to a continent was basically gone.
So, on the surface, this was a failure for Buffett, a tiny 1% loss. No big deal, right? Wrong. The lesson he learned from this one little trade was worth, well, billions.
I mean, just look at this number. If this is what Buffett went on to do in his early partnership years, an average annual return of nearly 30%. That's a staggering, life-altering number that made his partners incredibly rich.
But here's the key, and this is so important. He didn't get those returns by finding dozens more Marshall Wells. Buying statistically cheap, can't-lose companies was not the secret sauce.
The real takeaway, the absolute gold from this forgotten little flop, was profound. First, a cheap price tag won't save you if the business itself is a melting ice cube. Second, the quality of the people running the company and whether they care about the owners is absolutely critical. And finally, the big one, it is far better to buy a wonderful business at a fair price than a fair business at a wonderful price.
This experience helped pivot Buffett from being a pure cigar butt investor, just looking for cheap deals, to the quality-focused legend we know today. And it leaves us with the exact same question he would spend the rest of his career trying to answer: what is the real difference between just a cheap stock and a truly great business?
Today, we're digging into one of Warren Buffett's earliest and, well, weirdest investments. Long before anyone called him the Oracle of Omaha, he was just a 21-year-old driving across the country looking for deals. And one of his biggest bets wasn't on some hot new thing, but on a business that pretty much everyone agreed was on its last legs: a simple barrel maker.
You know, that's a quote from Buffett himself, and it kind of says it all. He was genuinely amazed at how obscure this business was. See, in his early 20s, he wasn't cooped up in an office. He was out on the road doing what he famously called scuttlebutt research. He'd just show up, unannounced, and start kicking the tires. And this one particular stop, it was a barrel company. An industry so old-fashioned it felt like a relic from a totally different time.
So that's the big question, isn't it? What on earth could a brilliant young guy like him see in such a dusty, forgotten business? The answer, it turns out, isn't just about this one company. It really pulls back the curtain on the fundamental principles that would end up making him the most successful investor in history.
All right, here's our roadmap. We're going to look at the bet itself, then we'll dive into this supposedly dying industry. After that, we'll uncover the hidden value Buffett found, see how a change in management became the real game changer, and finally, wrap it up with the huge lessons from this fantastic win.
Okay, let's kick things off with the bet itself. We got to go back to 1951. Warren Buffett is just 21 years old, and he's about to make a move that honestly is a perfect snapshot of his entire investment philosophy, right from the very beginning.
So take a look at this. This is Buffett's personal portfolio from that year. Now you can see his now famous Geico investment right there at the top, but look a little further down. Greif Bros Cooperage. And this wasn't some tiny speculative flyer. No, this was a major position he took with real conviction.
In fact, it was nearly 15% of his total assets, making it his second largest holding. I mean, just stop and think about that for a second. At 21, he put a huge chunk of his entire net worth into a single barrel company. That's not a casual bet. That is pure, unadulterated conviction. And where did that conviction come from? Well, it wasn't from sitting behind a desk. This is classic early Buffett. He actually drove to Delaware, Ohio, and just walked in. He didn't just get a meeting with the chairman. He spent hours just talking with guys on the factory floor to really understand the business from the inside out.
So, okay, he was convinced. But what exactly was this industry he was betting the farm on? This is where the story gets really interesting. Because Greif Brothers was a dominant player, for sure, but it was kind of like being the biggest fish in a pond that was quickly drying up. So first, just a quick definition, because who talks about this anymore? Cooperage is simply the business of making wooden barrels. It's an ancient craft, right? For centuries, it was absolutely essential for shipping, well, everything. But by the 1950s, its best days were definitely in the rearview mirror.
Now, within this industry, you had two main types. Tight cooperage was for liquids, think whiskey, beer, that kind of thing. Slack cooperage was for dry goods, like flour or sugar. This is a really key distinction because Greif was the absolute undisputed king of the slack barrel market.
Here's the problem, though. The world was moving on. People were switching to cheaper, more modern containers like paper sacks and steel drums. So this means Buffett was knowingly, with eyes wide open, buying into an industry that really looked like it was in terminal decline, which just makes you ask, why in the world would he do that?
And that question brings us right to the heart of this entire investment. It's all about finding incredible value where absolutely no one else is even bothering to look. This is where we get to see the young Buffett putting the lessons of his mentor, Benjamin Graham, into action to find what they called a massive margin of safety.
Okay, let's put the puzzle together. Piece number one is the price. At the end of 1951, the stock market was offering up shares of Greif Brothers Class A stock for just $18.25.
But, and this is a huge but, here's what Buffett saw when he looked at the company's actual books. The tangible book value, basically what you'd get if you just sold off all the company's physical stuff, was $39.60 per share.
So here it is, the whole opportunity in one simple chart. You could pay about $18 for something that was worth nearly $40 in real physical assets. The market was literally selling dollar bills for less than 50 cents. That huge gap between the price you pay and the value you get, that is the margin of safety. It's the holy grail for a value investor.
And if you dug even deeper, the value was even better than it looked on the surface. The company owned hundreds of plants and huge tracts of valuable timberland. Plus, Buffett spotted this little accounting quirk. Because of a method called LIFO, their inventory was being valued at old, much lower prices, which was hiding its true worth. And, to top it all off, the company had just bought back 30% of its own stock, meaning each remaining share now represented an even bigger piece of that very undervalued pie.
You know, it wasn't just about the assets either. If you looked at the company's earnings, it was the exact same story. You can see on this table, no matter how you sliced it, the valuation numbers were just crazy low. A PE ratio around 3 or 4, I mean the market average is usually 15 or higher. The conclusion was totally inescapable. The stock was just dirt cheap.
But here's the thing about a cheap stock. It can stay cheap forever if there's nothing to shake things up and unlock all that value. And that brings us to the human element of this story. The management game changer that turned what was just a cheap stock into a truly great investment.
This timeline here tells a little story of corporate drama. For decades, the company was run by this investor, John Rabel. But then, in 1946, a sharp young accountant named John Dempsey gets on the board. And when Rabel tries to lowball Dempsey's family to buy their shares, Dempsey flips the script, rallies support, and takes control of the whole company himself. Suddenly, there was a new sheriff in town.
And Dempsey was not some sleepy caretaker. He saw the writing on the wall for wooden barrels, and he immediately started steering the ship in a new direction. He used the company's assets and all its customer relationships to pivot hard into modern containers, like fiber and steel drums. He was the catalyst. He was the guy Buffett was really betting on.
So, you've got this perfect storm, right? A deeply undervalued company in a declining industry, but with a new, super sharp manager at the helm. The only question left is, did it actually pay off? Well, let's look at the results and what we can all learn from it. The numbers really do speak for themselves. This table shows the company's performance through the 50s. Just look at that top line, revenue. It grows from $29 million to almost $43 million by 1959. And net income, it nearly doubles over that same period. John Dempsey's pivot was a massive, undeniable success. You know, this investment also tells a fascinating story about two different legendary investors. For Buffett, it was a solid win. He held it for about 5 years, probably made around a 20% return every year. But for another investor, Phil Carrot, who actually got the tip from Buffett's dad, it was a life-changing grand slam. Carrot held on for 52 years, and his story perfectly illustrates the incredible power of long-term compounding when a great manager takes a cheap stock and turns it into a fantastic business.
In the end, this story from 70 years ago feels absolutely timeless. It just goes to show that if you combine deep, on-the-ground research, a huge margin of safety, and a smart bet on a great manager, you can find incredible returns, especially in the most overlooked, boring corners of the market. And it leaves us with a pretty provocative question for today, doesn't it? What dying industries are we all ignoring right now that just might be hiding the next hidden gem?
You know, we all think of Warren Buffett as the master of buying these wonderful, incredible companies. But what if I told you that one of his most important lessons ever came from a truly terrible one? Today, we're going to dive into the fascinating and honestly kind of frustrating story of a small textile mill that helped shape the entire philosophy of the world's greatest investor. This is the story of Cleveland Worsted Mills.
And yeah, that quote right there from the man himself, it really tells you everything you need to know, doesn't it? You can just feel the frustration in those words. This wasn't just some bad investment on a spreadsheet for him. This was personal. It was the kind of thing that teaches you a lesson you carry with you for the rest of your life.
All right, so let's set the scene. The year is 1952. You've got a 22-year-old Warren Buffett. He's working for his mentor, the legendary Ben Graham, and he spots what he thinks is the perfect investment. It's a company called Cleveland Worsted Mills. And on paper, wow, it was an absolute slam dunk, the very definition of the deep value strategy he learned at Graham's feet.
And just look at this thesis. I mean, it's perfect. First off, the stock was trading for less than its net current asset value. Now that's basically like finding a wallet with $100 in it and someone offers to sell it to you for $60. It had a bargain basement price to earnings multiple, it had been consistently profitable, and it was paying out this massive 8.7% dividend that looked totally safe. Oh, and the final seal of approval? His mentor, the great Ben Graham, he owned the stock too. Seriously, what could possibly go wrong?
Well, to understand what went wrong, you really have to understand the company itself. See, this wasn't some hot new tech startup. Cleveland Worsted Mills was an old-school business, and it had this long, complicated history that was completely tied to the absolutely brutal boom and bust cycles of the American textile industry.
Yeah, this timeline really tells the whole story, doesn't it? Founded way back in 1878, this company was a survivor. It made it through the Panic of 1893, a textile depression in the 20s, a few changes in leadership. Of course, the World Wars were a huge boom for them, with all the demand for military uniforms. And this is key. Right before Buffett invested, the company had just finished a huge modernization of its plants, so you can see why it looks like this seasoned veteran that was all geared up and ready for the future.
Okay, so with that history in mind, let's get back to what the young analyst Warren Buffett was actually seeing in the numbers, because this is where the story gets so compelling. The valuation was, by just about any metric you could imagine, ridiculously cheap.
This table really gets to the heart of it. Just look at those metrics. The price-to-earnings ratio was a little over 5. I mean, you were paying next to nothing for the company's profits. But the real kicker was the price compared to its assets. It was trading at just 0.62 times its net current asset value and only half its tangible book value. For a value investor, especially one trained by Ben Graham, these numbers were like a siren going off telling you to buy, buy, buy.
And this really shows the mismatch perfectly. The stock was trading for about $92 a share, but its net current asset value, again, just think of it as the company's wallet with its cash and inventory minus all its debts, that was over $149 per share. That meant, in theory, you could buy the company, shut it down that same day, sell off all the easy-to-sell stuff, and you'd walk away with a giant profit. This was the ultimate margin of safety that Ben Graham was always talking about.
And then there was this, the cherry on top, an 8.7% dividend yield. Now, in an era of pretty low interest rates, that was a massive return. You were getting paid almost 9% of your investment back every single year just to sit and wait for the market to figure out how cheap the stock was. The company was earning way more than enough to cover it, so that dividend looked absolutely rock solid.
But you know what's coming. This is where the story takes its dramatic turn. The rock-solid thesis, the perfect bargain, the investment that just couldn't lose, well, it started to completely fall apart. The actual business underneath those numbers was far, far weaker than anyone thought.
So what on earth went wrong, right? How could a stock that looks so perfect on paper turn into such a complete nightmare? Well, the answer lies in the brutal reality of that industry and the really crucial difference between a cheap stock and a good business.
This chart just shows you the collapse in brutal detail. The very year Buffett bought in, 1952, the earnings per share just plummeted by over 70%. And by 1954, they had all but vanished, down to a measly 45 cents a share. All of a sudden, that fat, rock-solid dividend was completely gone. So what happened? It was a perfect storm. Vicious competition from lower-cost mills, plus this huge shift in fashion towards new synthetic fibers. The business was dying.
Then, in 1954, the inevitable happened. The company slashed its dividend in half, and Buffett was furious. I mean, remember, he hadn't just bought this for himself, he had recommended it to his clients. As he tells it here, he flew all the way to Cleveland for the annual meeting to give them a piece of his mind, only to be completely blown off. He was just a kid, a totally powerless minority shareholder, forced to just sit there and watch his perfect thesis go up in flames. This is the moment it became, in his own words, Cleveland's worst mill.
And that should be the end of the story, right? A painful lesson for a young investor. But it's not. In a completely unexpected plot twist, this worst mill was about to produce a fantastic return for the shareholders who were lucky enough to hang out. So a year later, in 1955, the final nail hits the coffin. A major workers' strike. The CEO, a 76-year-old guy named Louis Paz, who was also a huge shareholder, he just looked at the terrible industry, he looked at the labor dispute, and he made a cold, rational calculation. Why keep fighting for a business that's dying? And so, he decided to just shut it all down. Liquidate the whole thing.
And hey, remember that hidden asset value we talked about? The whole reason Buffett bought in the first place? Well, this is where it paid off. Big time. The liquidation was a massive win for shareholders. Buffett's purchase price was around $92 a share. The final payout, which was distributed over a few years, came to nearly $200 a share. He more than doubled his money on his worst investment. So get this. Despite all the drama, the dividend cut, the collapsing business, an investor who bought in 52 and just held on ended up earning an annualized return of 21%. That's a fantastic result by any measure. The original thesis, that the assets were worth way more than the stock price, it was ultimately proven correct. It just happened through a total business failure, not a recovery. Crazy.
But here's the most important part of the whole story. Buffett didn't see this as a victory. Not at all. He saw it as a lucky break. And the experience taught him this profound lesson that would completely change his approach to investing forever. He called it the cigar butt lesson.
And this right here perfectly captures his thinking. Cleveland Worsted Mills was a cigar butt. You know, it was this discarded, ugly business that he picked up off the street for basically nothing because it had one good puff left in it, that liquidation value. And sure, that one puff was profitable, but it was not a pleasant or repeatable way to build wealth.
And he realized the deep, deep flaws with this strategy. First, in a struggling business, the problems just never end. As he famously said later, there is never just one cockroach in the kitchen. And second, and this is the most important part, any advantage you get from that initial cheap price gets completely eaten away by the terrible economics of the business itself. You might get one free puff, but you cannot build lasting wealth on cigar butts.
And all of this led him to this final, profound insight, and is captured so perfectly in this quote. Time is the friend of the wonderful business, the enemy of the mediocre. You know, getting lucky with a mediocre business like Cleveland Worsted Mills at a wonderful price is one thing. But Buffett realized it is far, far better to buy a truly wonderful business at a fair price and just let the magic of compounding do all the heavy lifting for you over time. And that lesson, learned from Cleveland's worst mill, is a huge part of what made him a legend.
You know, when we talk about Warren Buffett's greatest hits, we usually think of giants like Coca-Cola or Apple. But today, we're not talking about any of those. We're digging into the story of a tiny, failing bus company. And believe me, it holds one of the most important and almost totally forgotten lessons of his entire career. So let's get into it. First, to really get what Buffett did here, we have to talk about technological disruption. And this quote from 1899, it's just perfect. It's a hilarious reminder of how ridiculously easy it is to get the future completely wrong. Because, by the 1950s, the automobile hadn't just won, it had totally crushed the industry it replaced, the streetcar. And that industry was on its deathbed. And this is exactly where our story kicks off. Just take a look at these numbers for the Union Street Railway right after World War II. It's a bloodbath. Passengers just fall off a cliff, from 27 million down to 12 million. Revenues get chopped nearly in half. And then, the final nail in the coffin, by 1954, the company is officially losing money. So right away, we're faced with this big mystery. I mean, on paper, this company looks like an absolute train wreck, right? It's a relic from a bygone era, it's hemorrhaging customers, it's losing cash. So why on earth would a brilliant up-and-coming investor named Warren Buffett decide to put his own money into this? Okay, so the company we're talking about was the Union Street Railway of New Bedford, Massachusetts, a really small, thinly traded, and, as we've just seen, unprofitable bus company. This was the kind of stock that was so far off the beaten path, nobody on Wall Street was giving it a second thought. To really understand the genius of what Buffett saw, we first have to see what everyone else was seeing, which was a complete disaster. And to do that, we need to take a quick trip back in time to see just how far this company had really fallen. You know, the company's whole story is basically the story of American transportation in miniature. It started out with actual horsepower back in 1872. It boomed with the electric trolley, but then the automobile shows up, and that began the long, slow decline. They tried to adapt, sure, they added buses, but by 1947, the thing they were founded on, the streetcar business, was completely dead and gone. And this chart right here just shows the whole brutal backdrop. This wasn't just one company having a tough time. It was an entire industry getting wiped off the face of the earth. You can see it clear as day. The boom, the peak, and then an absolute collapse. Investing in this industry in the 1950s was like deciding to bet big on horse-drawn carriages after the Ford Model T came out. It just made no sense. So here's the crucial point to understand. This was not a turnaround story. The game was over. The technology was obsolete. By 1952, the factories that even knew how to build these things had completely shut down for good. And that fact makes Buffett's decision to jump in seem even crazier. But of course, Buffett wasn't betting on some miraculous comeback for the bus industry. He wasn't looking at the story at all. He was looking at the numbers. He saw something that was hiding in plain sight, right there in the company's boring old financial statements. He was using a strategy his mentor, the legendary Benjamin Graham, taught him. It's often called net-net investing, and the idea is actually incredibly simple. You find a company where the stock is trading for less than the value of its cash and other stuff you can sell easily, after you've paid off all its debts. Think about it like this. It's like finding a wallet with $10 inside, and you get to buy it for only $7. Who wouldn't take that deal? And here's the man himself, recalling the whole thing decades later with that photographic memory of his. He just rattles off the numbers like it was yesterday. He saw that this failing business was actually sitting on a huge pile of cash and super safe U.S. Treasury bonds. And what is so cool is that we can go back and see the exact numbers he was looking at in these old Moody's manuals from 1953. Look, there's the line for cash, $169,000. And right below it, U.S. government securities, $800,000. The proof was right there, in black and white for anyone who bothered to look. So once you added up all that cash and you subtracted every single liability the company had, you were left with this magic number. The company had $48.13 per share in pure, cold, hard, net cash. And here, my friends, is the punchline. At the exact time Buffett was buying this thing up, the stock was trading for around $35 a share. Just let that sink in for a second. You could pay $35 to buy a piece of a company that held over $48 in cash for that exact same piece. It was literally buying a dollar for less than 75 cents. It's an unbelievable bargain. But wait, it gets even better. The deal was even sweeter than that. That $35 price tag didn't just get you the $48 in cash. It meant you got all the company's other assets for free. The fleet of buses, the land they owned, the buildings, these weird little insurance trusts, all of that was just gravy on top of an already incredible deal. Okay, but here's the catch with these net-net investments. A cheap stock can stay cheap forever if nothing happens to unlock all that value. You need a catalyst, right? Some kind of event that forces the market to wake up and see what the company is really worth. And a young Warren Buffett wasn't the type to just sit around and wait for that to happen. This part of the story shows that Buffett wasn't just a passive number cruncher, he was a hustler. He found the idea by painstakingly reading through these dense financial manuals. The stock was so obscure he had to get creative, even running ads in the local New Bedford newspaper just to find people willing to sell him shares. He was so active, he was actually competing against the company itself, which was also trying to buy back its own cheap stock. Finally, he decided enough was enough, got in his car, and drove all the way to Massachusetts to force the issue himself. So he has this meeting with the company president, a guy named Mark Duff. And as Buffett's about to leave, Duff just casually mentions they're thinking about returning some of that cash pile to shareholders. He brings up some quirky Massachusetts law that meant they had to do it in multiples of the stock's par value. And then he drops the bomb. We're thinking of using 2 units.
2 units, that meant a $50 dividend, a $50 cash payment for every single share on a stock that Buffett had been buying for about $35. This was it. This was the catalyst he had been looking for.
The result was just staggering. In one single dividend payment, he got more cash back than he had paid for the entire stock in the first place. And the best part? After pocketing all that cash, he still owned the stock, which still had value from all the gravy assets left over. It was an absolute, undeniable home run. But believe it or not, the story doesn't end there. In fact, this obscure little bus company has a shocking and direct connection to the massive company that would eventually make Warren Buffett a global icon.
You see, sitting on the board of directors of this tiny bus company was a man named Seabury Stanton. Now, Stanton also happened to run a local textile business called Hathaway Manufacturing, and wouldn't you know it, his mills were right on the Union Street bus lines. Well, just a year later in 1955, his company merged with another textile mill and was renamed Berkshire Hathaway.
So fast forward a few years. Buffett invests in Stanton's new company, Berkshire Hathaway, for the exact same reason. It was another one of these super cheap net stocks. Stanton makes an offer to buy Buffett's shares back, and they shake hands on a price. But when the official offer comes in the mail, Stanton had lowered it by a tiny fraction, an eighth of a dollar. Well, Buffett was so insulted by this petty move that instead of selling, he got angry. And he went out and aggressively bought enough stock to take complete control of the company, just so he could fire Stanton. And that one act of anger, over 12.5 cents, changed the course of financial history forever. And that really brings us to the ultimate lesson from this forgotten little bus company. The greatest opportunities are often hiding in plain sight, tucked away in dying industries and unloved companies that everyone else has completely written off. But as we saw with Buffett, just finding that hidden value isn't always enough. You often need a catalyst, or you need to be the catalyst to unlock it. Which really makes you wonder, how many of these incredible bargains are just sitting out there today, hiding in plain sight, waiting for the right push to reveal their hidden worth? All right, let's dive into a story you've probably never heard. It's the secret origin story of one of the greatest financial empires on Earth. And it all starts with a single, seemingly terrible investment. This is about seeing immense value where literally no one else could.
And that really is the million-dollar question, isn't it? It sounds completely insane. Why would anyone, in their right mind, stake their future on an industry that everyone agreed was headed for the history books?
Well, because that is exactly what a 22-year-old, totally unknown Warren Buffett did. And the lessons he pulled from this one forgotten company, well, they became the actual blueprint for Berkshire Hathaway. So let's get into it. So our story starts with a company that, on the surface, looked like one of the worst investments you could possibly make, the Philadelphia and Reading Coal and Iron Company. By 1954, Buffett had sunk $35,000 into this company. Now, I know that might not sound like a huge number today, but you have to remember, for a 24-year-old Buffett, this was a massive, massive bet. It was his single largest personal investment. He started buying shares at $19, and when the price tanked to $9, he didn't panic. Nope, he doubled down and bought even more. Now, to really wrap your head around just how wild this bet was, we have to look at the state of the company and, the whole industry. And to put it mildly, things were looking pretty bleak. Philadelphia and Reading, or P&R as we'll call it, was a classic fallen giant. I mean, this company was once the biggest anthracite coal operator in the entire country. But as you can see here, its glory days were long, long gone. Production peaked way back in 1917. Then came a forced split from its super profitable railroad business, then the Great Depression hits, and boom, bankruptcy in 1937. And even after it reorganized, the bleeding just never stopped. And these charts, wow, they really tell the tale, don't they? I mean, on the left, you see U.S. anthracite coal production just falling off a cliff. From that peak in 1917, production had crashed almost 70% by the time Buffett got involved. Cheaper, cleaner, more convenient stuff like oil and gas were just taking over. The entire industry was in a death spiral. So, with that pretty grim backdrop, what on earth did a 22-year-old Warren Buffett see? Well, he was doing what he does best, looking where no one else was, digging past the obvious decay, and going deep into the company's financials. Okay, so this right here is what every other investor on Wall Street saw. The income statement was a total disaster. If you look at that 1953 column, sales were down, pre-tax income had basically vanished, and earnings per share were a measly 7 cents. I mean, the core business was very clearly collapsing. But, and this is where the magic happens, Buffett turned the page. He looked at the balance sheet. And this is the genius of the whole thing. Because while the company wasn't earning any money, it was sitting on an absolute fortress of assets. It was like reading about two completely different companies. Let's break down this simple math Buffett was doing on the back of a napkin. First, he looks at something called net current assets. That's basically the easy-to-sell stuff, cash, inventory, minus all the debt. That alone was worth over $9 a share. Then, he spotted a hidden treasure, these things called calm banks. They were just giant piles of waste coal that had been sitting there for decades. But new technology meant you could actually reprocess them for a profit. He figured those were worth another $8 a share. So you add it all up, he's seeing a hidden value of around $17 a share for a stock he's buying for as little as $9. That is a massive, massive margin of safety. But there was one more piece to this puzzle, a real ace up his sleeve. Buffett knew that his professor, his mentor, the legend himself, Ben Graham, had also bought the stock and was actually on the company's board. He was betting that Graham, the ultimate shareholder advocate, would eventually force management to unlock all that trapped value. And wouldn't you know it, that's exactly what happened. But this story isn't just about unlocking value by selling off assets. Oh no, it's about a complete and total transformation. This company was about to pivot from coal to something no one could have ever seen coming. It all started with a classic shareholder revolt. Ben Graham teamed up with other fed-up investors, and by 1955, their little group controlled almost 30% of the company. But the real visionary here, the guy driving the change, was Mickey Newman, the son of Graham's business partner. While Graham was actually getting pessimistic, Newman saw the potential. And when the company posted a huge loss in 1954, that was the opening they needed to grab 3 seats on the board. This quote from Mickey Newman is just incredible. It says it all. You've got Ben Graham, the father of value investing, ready to throw in the towel and sell. But Newman saw something more. He saw a giant potential tax asset from abandoning the old mines that could be used to shield future profits from a completely new business. So the activists, with Newman leading the charge, performed a complete overhaul. They changed the name, dropping coal and iron for good. They changed the corporate charter, allowing it to do basically any business it wanted. And they totally flipped the strategy. They stopped digging for more coal and started using the company's cash to buy new, profitable companies. And Newman's very first move was a stroke of absolute genius. He took the cash P&R had from selling off its extra inventory and bought Union Underwear, the company that made Fruit of the Loom. Yup, a coal company was now officially in the underwear business. And you have to hear what Buffett himself said about this deal years later. He said, "I get goosebumps just thinking about such deals." And here's why. The structure was brilliant. P&R bought Union Underwear for $15 million, but right away they used $2.5 million of Union's own cash to help pay for it. A huge chunk of the rest was financed with notes that required 0 interest and were only paid back out of future profits. And the best part? Those future profits would be totally shielded from taxes because of P&R's massive losses from the old coal business. It was a financial work of art. Now, this incredible turnaround didn't just make a bunch of investors rich. For the young Warren Buffett, who was watching this whole thing play out, it provided the exact step-by-step blueprint he would later use to build Berkshire Hathaway. And the results, I mean, they were just staggering. Look at this. In 1953, before the activists really got going, earnings per share were just 7 cents. By 1967, after years of buying up new businesses, earnings per share had exploded to $16.56. Sales grew almost 13% a year, and earnings grew at an unbelievable 47.8%, compounded annually. Just insane. So here it is. This is the blueprint. Every single key strategy that would later make Berkshire Hathaway famous was tested and perfected right here. Taking cash from a dying business, textiles for Berkshire, coal for P&R, and moving it into better ones. Using those tax losses to shelter profits. Buying good companies with great managers and then just leaving them alone. Gaining total control to make these changes happen. It's all right here. And here's the final incredible twist to the story. decades later, history came full circle. When Fruit of the Loom and another one of P&R's old acquisitions, Acme Boots, ran into trouble, guess who stepped in to buy them both? Yep, Warren Buffett's Berkshire Hathaway. The lessons from that very first great investment paid off for a lifetime. It's just such a powerful story about looking past the obvious and seeing what others miss. And it leaves us with a really fascinating question to think about. What industries today, the ones everyone has written off for dead, might be hiding the kind of hidden value that builds the next great empire? Thanks for joining me. So today I want to dive into a story that I just find fascinating. It's a little-known investment from the early days of Warren Buffett and Charlie Munger, but it is an absolute masterclass. It's really the blueprint for how they think, and it's all about finding these incredible opportunities where it's almost impossible to lose. You gotta love this quote from Charlie Munger, right? It just perfectly sets the stage. I mean, it flies in the face of the very first thing we're all taught about investing. Diversify. Don't put all your eggs in one basket. Well, the story we're about to get into is about two guys who not only used one basket, they basically mortgaged the farm to buy it. All right, so that brings us to the heart of our story, and it's a real head-scratcher. It's a situation that was so weird, so unusual, that pretty much every other investor out there was running for the hills. But for a young Buffett and Munger, it was the opportunity of a lifetime. Now check this out, because this is where things get really interesting. Imagine you find a company that, after selling off its main business, is holding $19.30 per share in cold, hard cash, like cash in the bank. But then you look at the stock price, and it's trading for less than C17. You could literally buy the stock for less than the cash it was guaranteed to have. So the million-dollar question is, why? Why was nobody else touching this? What was the catch? Well, while everybody else saw danger, Buffett and Munger saw a massive mispricing. The company was British Columbia Power, and they didn't just nibble at this opportunity. They went all in. I mean, Munger bet his entire partnership, and then he used leverage, borrowed money, to buy even more. For Buffett, it shot up to become the second largest holding in his partnership. This wasn't just a bet. This was a screaming, table-pounding conviction that the market had it completely wrong. The best way to think about what they found is through this simple analogy. It's just perfect. It was like finding a special kind of vending machine. You put 85 cents in, and you knew with almost absolute certainty that $1 was going to come out. Now, the rest of the market was freaking out, right? They were worried about how long it might take to get the dollar, or maybe if the machine was broken. But Buffett and Munger, they just focused on the simple fact that the dollar was in there. So you're probably asking, how on earth does a situation like this even happen? It seems too good to be true. Well, the answer isn't in some dusty finance textbook. It's all about politics, a really ambitious premier, and a company that got in his way. Okay, so let's walk through how this all went down. You had the Premier of British Columbia, W.A.C. Bennett, and he had this grand vision for these huge hydroelectric power projects. The problem? He needed BC Electric, the main subsidiary of our company, to play ball, and they wouldn't. So in August of '61, Bennett got fed up, and his government did something just jaw-dropping. They passed an act and simply seized the company. They took it. The reaction was complete shock. The business world just lost its mind. People were calling him a dictator. A private company had just been nationalized in Canada. Now, the government's first offer was kind of weird, to be honest. It was like a shell game. The total price they offered seemed fair, but they played around with the numbers, overpaying for some small stuff and way underpaying for the main utility business. It was messy. But then, a year later, they passed an amending act that cleaned everything up. It restructured the whole deal, and the result was that BC Power was left with this huge mountain of cash. And that moment, right there, is when this bizarre political mess turned into a crystal clear investment opportunity. And this is the magic number, C19 30 cents. After that second act, this is how much net cash the company was holding for every single share. And remember, this wasn't some Wall Street estimate or projection. This was the actual cash sitting in the bank. And yet, the stock was trading below C17 a share. The market was just so terrified of the government seizure and the legal battles that it was pricing the company as if that cash might just vanish into thin air. Okay, so we've got the crazy backstory. Now for the fun part, the analysis. To really understand why Buffett and Munger were so calm and confident when everyone else was panicking, we can use this brilliant 4-question framework that Buffett himself uses for these kinds of special situations. Here it is. It's so simple, It's Bryant. 4 questions. How certain is it? How long will it take? Is there any extra upside? And, most importantly, what's the downside? It's just a powerful way to cut through all the noise and focus on what really matters. So let's apply this exact framework to the BC Power investment and see what they saw. First up, certainty. How sure were they that the shareholders would actually get paid? The answer was, pretty darn sure. I mean, think about it. The government had already taken the assets and baked them into a new state-run company. Trying to undo that would have been an absolute nightmare, politically and logistically. Plus, if you looked at what BC Power was doing, they weren't trying to get their company back. They were just fighting for more money. The payout was going to happen. Okay, question 2, timing. Now, this was the big question mark for most people. The headlines were warning this could be tied up in court for 5 years or more. But by the time Buffett and Munger were buying, the case was already moving pretty fast, heading to the Supreme Court. Both sides had a reason to get it over with. And here's the crucial part. The company was earning interest on all that cash, which basically paid for the legal fees. So time wasn't really their enemy. And the potential for something even better? Oh yeah, this is where the deal gets really, really sweet. Since they were already buying the stock for less than the cash it held, any extra money the company won in its lawsuit was just pure profit. It was a free option on a big win in court. As the source material calls it, it was pure gravy. But all of that brings us to the 4th and final question. And honestly, for guys like Buffett and Munger, this is always the most important one. This is their secret sauce right here. It's their obsession with the downside. So let's really think about this. What happens if everything goes completely wrong? What's the absolute catastrophic worst-case scenario? Let's say the courts throw the whole thing out, the government gives up, and the deal just evaporates. What are you left with? And here's the absolute genius of the whole thing. The worst-case scenario wasn't that bad at all. Just look at these numbers from the decade before the takeover. This wasn't some risky startup. BC Power was a rock-solid, profitable, growing utility business. So if the deal fell apart, Buffett and Munger weren't left with a worthless piece of paper. They were left owning a great business that was probably worth more than the takeover price anyway. It was a classic heads I win, tails I don't lose much situation. Now, there was one other little detail that scared a lot of people away. Something called convertible debentures. Sounds complicated, right? All you really need to know is that it's a type of debt that could potentially be turned into new shares of stock, which would water down the value for everyone else. It looked messy and introduced another layer of uncertainty. But here's the thing. Buffett and Munger actually read the fine print, and they realized it was a total non-issue. The government had already taken responsibility for that debt when they seized the company. And even better, they quickly started buying back the bonds, making the whole problem just disappear. So while other investors saw this scary-sounding financial instrument, the actual risk was basically zero. So they did the analysis, they understood the real risks, or lack thereof, and they placed their huge, concentrated bets. All that was left to do was sit back and wait for the final act of this whole corporate drama to play out in the courts. And then, bam, the ruling comes down. July 29th, 1963, the Chief Justice drops a bombshell. He declares the government's seizure of the company was illegal and unconstitutional. It was a complete and total victory for BC Power. What did that mean? It meant the government had to pay up. Big time. They were forced back to the negotiating table and had to cough up an extra $25.3 million on top of what they'd already paid. That was the gravy we were talking about, and it was a huge serving. It worked out to another $5.30 per share for shareholders like Buffett and Munger. So here's the final tally. You can see how it all adds up. The price they paid, the dividends they collected, and the final liquidating payouts. All in, it was a total return of over 54%. And for Munger, who had used all that leverage, this one investment basically made his partnership's returns for 2 straight years. Just an absolutely incredible outcome. So what's the big lesson here? It's that real investing genius isn't always about finding the next rocket ship stock. Often, it's about finding situations where the odds are just stacked overwhelmingly in your favor. By obsessively, relentlessly focusing on the downside, on what could go wrong, Buffett and Munger found an opportunity where it was almost impossible to lose. And in doing so, they unlocked a massive, low-risk upside. It really makes you wonder, doesn't it? How many of these kinds of opportunities are hiding out there today, just waiting for someone to ask the right questions?
All right, let's jump right in. Picture this. It's 1963, and American Express is, well, it's more than a company. It's an absolute bedrock of trust, an institution that spent over a century becoming as good as gold. Their name meant your money was safe. But in just a few short weeks, that entire fortress was brought to its knees by one of the strangest, most audacious frauds you've ever heard of. It's a wild story, folks. It's got a swindler straight out of a movie, vast lakes of phantom salad oil, and a young investor you might have heard of, a guy named Warren Buffett.
Inconceivable. You know, this quote right here, from an Amex executive right before the sky fell in, it says it all. There's a level of confidence there, a kind of hubris, right? The belief that their systems were perfect, that they just couldn't be fooled. Well, they were about to get a very, very painful lesson that the only thing truly inconceivable was the sheer scale of the lie they'd just put their good name on.
And it all started right here, this bleak-looking tank farm in Bayonne, New Jersey. This was ground zero. In November of '63, a company called Allied Crude Vegetable Oil, well, it went belly up. And that was a huge problem for Amex, see? Because a little division of theirs had guaranteed the oil that was supposed to be in these tanks. So when the inspectors rushed over, they found something truly shocking. The oil wasn't just gone. The truth was, most of it had never even been there. We're talking about $175 million of vanished oil.
And the fallout? Oh man, it was immediate. It was like a bomb went off on Wall Street. The New York Stock Exchange had to suspend 2 brokerage firms, just like that. Sheer panic ripped through the markets. And right there, at the very center of this massive financial earthquake, was American Express. Their name was on the hook for a sum so gigantic, it honestly threatened to wipe the entire company off the map.
Let's really wrap our heads around that number for a second. $175 million in 1963. Today, that's well over $1.5 billion. It's just a staggering amount of money. Somehow, American Express had put its stamp of approval on receipts for almost 1.3 billion pounds of oil. And the con itself? It was almost brilliantly simple. The tanks were filled almost to the top with seawater. All the crooks had to do was pour a few feet of actual salad oil on top, just enough to fool the dipsticks.
So, you have to be asking yourself, who is the mastermind behind a scheme this huge? Well, meet Anthony Tino DeAngelis. Tino was a character. I mean, this guy felt like he walked right out of a movie. He had a track record of bankrupting companies. He'd been in trouble for cheating on a school lunch program, of all things. Everyone knew he was shady. And yet, this is the guy who somehow convinced the buttoned-up, respectable American Express to be his partner in crime.
Now, Tino's genius was in exploiting this really boring-sounding corner of finance called field warehousing. Stick with me here, because this is the key. It's supposed to work like this. A company, like Tino's, has a bunch of inventory, salad oil in this case. A trusted company, like Amex, sends people to check on it, verify it exists, and then they issue a receipt guaranteeing it's there. Tino takes that Amex-backed receipt to a bank, gets a huge loan. The bank's happy, Amex is guaranteeing this stuff. Amex is happy, they get a fee. The whole system is built on one simple, powerful idea: trust.
And Tino took that trust and just blew it to smithereens. His scheme was beautiful in its audacity. Step 1, get Amex to put its golden name on his oil. Step 2, take those guarantees and borrow mountains of cash. Step 3, use all that money to make wild, leveraged bets in the market. And of course, the secret ingredient, the diabolical heart of the whole thing, the collateral, the oil itself, was almost entirely a fiction.
You know what's just staggering, though? Amex had so many chances to see this coming. This wasn't some subtle genius crime. It was loud and sloppy. They got anonymous phone calls saying, hey, the tanks are full of water. Their own people found weird amounts of water in the tanks. At one point, the amount of oil they were guaranteeing for Tino was literally more than the US government said existed in the entire country. I mean, come on. And on top of all that, when they finally asked to see his books, Tino just said no, and they let it slide. Every single red flag, they just drove right past it.
So yeah, the money was a massive, massive problem, but it actually wasn't the real problem. For American Express, what was really on the line was something much bigger. The thing that was truly on the verge of collapsing was the company's most valuable possession, and it's something that never ever shows up on a balance sheet. It was their reputation. 113 years of trust. You have to understand, their entire history was built on this one idea. They started in 1850 as basically an armored car service for banks. From day one, their whole reason for being was solving one simple problem. How do we make money safe and easy to move around? The money order, the game-changing traveler's check,
And then, of course, the card in '58. Every single innovation was just a new answer to that same old question.
And think about it. Every one of those products, whether it was the paper traveler's check or that iconic green piece of plastic, it wasn't just an object. It was a promise. It was a promise that said your money is safe with us. No matter where you go in the world, we've got your back. That promise, that was the entire business. That was the whole ballgame.
And you know, this old symbol of theirs, it says it all, doesn't it? A watchdog guarding a safe. It's so simple and so powerful. The message is crystal clear. We are your money's bodyguard. And the salad oil scandal? Well, it was like someone had just poisoned the watchdog. It threatened to destroy everything.
Okay, so Wall Street is in a full-blown meltdown. Everyone is panicking, dumping the stock like it's radioactive. But there was this one guy who saw things a little differently. A 33-year-old money manager from Omaha, Nebraska. Nobody really knew who he was back then. His name was Warren Buffett. And where everyone else saw total disaster, he started to see the opportunity of a lifetime.
And you can't really blame people for panicking. The market was terrified. And here's why. Because of some weird old legal structure, Amex shareholders could actually be held personally responsible for the company's debts. That means you could lose not just your investment, but everything. Your house, your car. So, naturally, everyone just sprinted for the exits. The stock price was in an absolute free fall.
But Buffett, he's looking at the exact same flaming wreckage, and he is seeing something completely different. The market saw a black hole of debt. Buffett saw a big, painful, but ultimately survivable bill. The market saw a brand that was ruined forever. Buffett suspected he was looking at an incredible brand that had just made a very, very dumb mistake. He was looking right through the noise, trying to see the real business underneath.
So how did he figure this out? Well, he didn't just lock himself in an office with a bunch of spreadsheets. Nope, he got his hands dirty. He did what he called scuttlebutt research. He literally hit the streets. He became a detective, talking to bankers, restaurant owners, regular customers, trying to find the answer to one simple but incredibly important question.
And this was it. This was the whole thing right here. Forget the screaming headlines and the panic on Wall Street. Did the average person, the guy on a business trip using his card, the tourist buying traveler's checks, did they even know or care about some bizarre scandal involving salad oil in New Jersey? Had any of this chaos actually changed how real customers felt about American Express?
And the answer he found? Well, it was definitive. And it teaches us maybe one of the single greatest lessons in all of investing. The huge, and I mean huge, difference between the price of a stock and the true value of the business it represents.
Now, check this out. This is what he found, and it is just wild. While Wall Street was absolutely torching the stock, look at what was happening in the real world. The core business wasn't just okay, it was booming. Traveler's check sales were up 28%, and charge card spending up an incredible 44%. The scandal was all over the front page, but out in the real world, nobody cared. Customer behavior hadn't changed one bit.
So there it was, the proof. The brand was bulletproof. The financial hit was big, but they could survive it, and the underlying business was a powerhouse. He realized the company's real asset, that trust in customers' minds, was totally unharmed. The market was giving him a gift, a chance to buy a wonderful business at a truly silly price. And he didn't just nibble. He backed up the truck, eventually putting 40% of his entire fund into Amex stock.
And the results? Well, let's just say it paid off. His partnership just crushed the market for the next 4 years, and Amex was the rocket fuel. That $13 million bet turned into $28 million. The funny thing is, the scandal that was supposed to kill American Express ended up being the very thing that created the legend of Warren Buffett.
And what's so great is that Buffett himself knew how important this moment was. He later wrote to his partners and basically said, you know, I'm good with numbers, but my best ideas, the really huge ones, they don't come from a spreadsheet. They come from a flash of insight about something you can't quantify, like the power of a brand. This was the moment he went from being a brilliant number cruncher to being, well, Warren Buffett.
And all of this leaves us with a really interesting question for today. This whole story is just a powerful reminder that the most valuable thing a company owns, its reputation, is totally invisible. You can't find it on a balance sheet. It only exists in our heads, in the minds of customers. So I'll leave you with this to chew on. As you look around today, what modern brands do you think have that same kind of priceless, untouchable value? What brands today could survive their own salad oil scandal? It's really something to think about.
So, what if you could find a billion-dollar engine hidden inside a company that pretty much everyone else had left for dead? And I'm not talking about some hypothetical situation. It's exactly what a young Warren Buffett did way back in the 1960s. Today, we are going to unpack one of the great detective stories in the history of finance, Buffett's absolutely brilliant bet on a company that looked like a total wreck, Studebaker. This is classic Buffett, right? You see, he doesn't really care if a stock is worth exactly $73.50. What he wants to know is if it's worth at least $110, but he can buy it for under $30. That huge gap, that canyon between the price you pay and the value you get, well, that's everything. And that idea right there is the key that unlocks this whole incredible Studebaker story. And this is where our mystery really begins. By the mid-60s, Studebaker, this legendary American car company, was on its very last legs. Yeah, the stock was cheap, but it looked cheap for a darn good reason. So why on earth did a sharp, up-and-coming investor like Warren Buffett see this massive opportunity that literally everyone else was missing? Okay, so to solve this puzzle, first you have to understand just how famous Studebaker actually was. This wasn't some obscure little company. This was a true American institution. I mean, just let that sink in for a second. On the night he was assassinated, Abraham Lincoln, President Lincoln, rode to Ford's Theater in a Studebaker carriage. That's how deep this company's roots went. It was an icon of American prestige long, long before it ever built a single car. But as we all know, prestige doesn't pay the bills. The company's historic move from horse-drawn carriages to automobiles was followed by this long, slow slide into, well, absolute chaos. And this timeline, it just lays it all out, doesn't it? In 1916, they're in the Dow, a titan of industry. But just 9 years later, they get kicked out, replaced by General Motors. I mean, the sheer scale of the big three, GM, Ford, and Chrysler, was just too much to compete with. Studebaker stumbled through bankruptcy, a terrible merger with Packard, and finally, the absolutely heartbreaking closure of their main plant in South Bend, Indiana. The car business was, for all intents and purposes, dead. Okay, but here's where the plot really thickens. As the car business was dying, the management went on this, well, desperate shopping spree. They turned Studebaker into a messy, confusing conglomerate. So by 1965, if you bought a share of Studebaker, you weren't just buying a failing car company. You were also buying all of this. I mean, look at this list. It is all over the map. You got floor polishers, missile nose cones for the space race, tractors, generators, and a famous motor oil additive called STP. It was a complete hodgepodge. And here's the kicker. The company gave investors almost no detailed information on how any of these individual businesses were doing. It was a total black box. Now, this kind of situation, this is exactly the kind of messy puzzle that Warren Buffett just loves to solve. While most analysts saw a dying car company with a bunch of random junk bolted on, Buffett decided it was time to put on his detective hat. He just knew there had to be more to the story. So this is what Wall Street was looking at, and you can see why they were just scratching their heads. Look at these numbers with me. Sales, plummeting. Total assets, shrinking. By all accounts, this thing looks like it's in a death spiral. But then, wait a minute, what's this? Net income. After a massive loss in 63, they are suddenly profitable in 64. How? Where on earth was that profit coming from? The official reports were a total brick wall. You see, for Buffett, just buying something cheap because the numbers are confusing, that's not investing. That's just rolling the dice. He wasn't interested in gambling. He needed to find that margin of safety he's so famous for talking about, that one rock-solid piece of value that would protect his entire investment no matter what happened to the rest of the company. And this is where the story becomes legendary. He couldn't get the information he needed from the company's reports, so he did something most Wall Street guys would never dream of. He went out into the real world to find it himself. He knew that one of those 10 businesses, STP, got its main ingredient from Union Carbide, and that it was shipped in tank cars. So he figured, if I can just count the cars, I can get a real-world read on how STP's business is actually doing. And you know what? What Buffett found in that rail yard, it changed everything. He discovered Studebaker's real engine. And believe me, it had nothing to do with cars. It had been hiding in plain sight the entire time. So what did those tank cars tell him? Well, they told him that STP's business was absolutely on fire. Sales were growing at an incredible 44.5% clip. This wasn't some forgotten little side business. This was a rocket ship. And the story gets even better. Not only was STP growing like a weed, it was wildly profitable. A pre-tax profit margin of nearly 37%. For any business, that is just phenomenal. So, hidden inside this dying industrial giant was this small, fast-growing, high-margin consumer brand. So here's the big reveal, the absolute crux of the whole thing. Buffett figured out that the value of just this one single division, STP, was greater than the market price for the entire Studebaker Corporation. He was essentially getting STP at a fair price and then getting 9 other businesses, tractors, generators, missile parts, for free. And this right here, this is the math, plain and simple. It's brilliant. Look, you put a totally reasonable growth multiple on STP, and you get a value of almost $26 per share. Then you add in a conservative value for the tractor and generator businesses, plus the company's tax assets, you get a total value of nearly $40 per share. And remember, he was buying the stock, the whole shebang, for around $18. That, my friends, is an enormous margin of safety. So Buffett and his partner Sandy Gottesman bought up the stock. And you know what? They didn't have to wait very long for all that detective work to pay off. Not long at all. Just a few months later, boom, a tender offer comes in at $30 a share. It was like a light switch just flipped on for the rest of Wall Street. The market suddenly woke up to the hidden value that Buffett had already figured out. The stock rocketed past $40, proving his quiet detective work had been absolutely spot on. It was a massive, quick win. And this whole story is the perfect real-world definition of Benjamin Graham's margin of safety. Buffett didn't need to know exactly what the refrigerator business or the floor polisher division was worth. Who cares? His conviction in the value of STP was so strong that it was his rock. It protected his entire investment. Everything else was just gravy. And that's really the ultimate takeaway here. We live in a world where we're just drowning in data, right? We think we need to know everything about an investment. Buffett's work here proves that's just wrong. You don't need exhaustive research on 10 different divisions. You need to do brilliant, proprietary research on the 1 or 2 that truly, truly matter. Which leaves us with a final question for today. Companies now are more complex than ever before. They're filled with different segments, new ventures, confusing financial reports. But you have to wonder, just like Studebaker back in 1965, some of them have these powerful hidden engines humming away, just waiting for a detective to find them. The only question is, are you looking in the right places? Thanks for joining me.
All right, let's talk about one of the most famous mistakes Warren Buffett ever made. Seriously, it's a story about a department store in Baltimore, a deal that looked absolutely perfect on paper, and a lesson that would end up changing how Berkshire Hathaway invests forever. So let's dive right in. You really can't tell this story without starting with this quote from Charlie Munger, Buffett's right-hand man. I mean, it's just brutal. Munger is famous for not pulling any punches, and this perfectly sums up the pure, unadulterated relief they felt when this whole thing was finally over. It wasn't just a bad investment for them, it was this huge weight they were just thrilled to get rid of.
In Buffett, he wasn't any nicer about it. He used this old country song lyric to explain how he felt after they sold the business. And the punchline, of course, is that he was so happy to be rid of the company, the wife in this analogy, that he didn't even care about losing this friend. That tells you everything you need to know about how painful owning this store really was.
So you have to ask, how on earth did this happen? How did 3 of the smartest investors on the planet, Warren Buffett, Charlie Munger, and their partner Sandy Gottesman, end up in a deal that they would talk about with regret for decades? Well, it's a really fascinating story about the massive difference between a cheap price and a genuinely good business.
Okay, so the year is 1966. To actually buy the store, the 3 of them set up a brand new holding company just for this deal, Diversified Retailing. Now, the ownership here is really important. The Buffett Partnership, which was Buffett's main investment vehicle at the time, owned a whopping 80% of it. This was no small side project. This was a major bet, making up about 10% of the partnership's entire assets. The stakes were incredibly high.
But here's where it gets interesting. While Buffett and Munger have always painted this as this epic failure, their other partner, Sandy Gottesman, kind of tells a different story. He's on record saying he thinks the story of the mistake has grown way out of proportion. Maybe because, in the end, they didn't really lose a ton of money. He saw it more as a tough situation they worked their way out of, not a total disaster. It just goes to show you the reality was probably a bit more gray than the famous quotes let on.
To really get why they made this deal and why it went so sideways, we got to kind of jump in a time machine and go back to the mid-1960s. You have to understand the retail scene in Baltimore back then, which was, to put it lightly, an absolute war zone.
And this was the prize. Hochschild Kohn & Co. I mean, look at it. A huge multi-story landmark right at the corner of Howard and Lexington, which was the absolute heart of downtown Baltimore shopping. It had been around for nearly 70 years, a real institution. It was more than just a store. It was a family-owned pillar of the community, where generations of people bought just about everything.
Now, Hochschild Kohn wasn't operating in a vacuum. It was one of what they called the Big Four department stores. And get this, all four of these major rivals were located within a single city block of each other. Can you just imagine that? A ferocious, day-in, day-out slugfest for every customer who walked down that street.
But here's the thing. While these four giants were locked in this epic battle downtown, the ground was literally shifting underneath them. Their customers were packing up and moving to the suburbs. And who was waiting for them out there? A whole new breed of competitor, the big national chains and the discount stores, who could operate cheaper and on a much bigger scale. The entire business model was starting to crumble.
So it's in this chaotic environment that the Kohn family decides, you know what? We want out. And the deal they put on the table, well, for a bargain hunter like Warren Buffett, it must have looked like an absolute slam dunk. Almost too good to be true.
So you really have to try to get inside Buffett's head back in 1966. Why did this deal, which looks like such an obvious trap in hindsight, seem like a classic, can't-lose investment to him? Well, like with most things Buffett, the answer is in the numbers.
First off, you look at the company's track record, and it looked really solid. Over the last 10 years, sales were climbing steadily. Even better, the operating income had more than tripled. The most recent year, 1965, was a record year for them. This didn't scream business in trouble. It looked like a steady, money-making machine.
And then we get to the price tag. This is the real kicker. They bought the entire company for just $12 million. Now here's the key. That price was less than its tangible book value. Basically, that means they were buying all the company's physical stuff, the inventory, the buildings, the cash in the bank, for less than what the accountant said it was worth. For a value guy, that's the ultimate safety net.
And it got even better. Buffett, being Buffett, dug in and found what he thought was even more hidden value. He figured the real estate was worth more than what it said on the books, and because of a weird accounting rule, the inventory was actually worth an extra $800,000. So he's seeing these extra cushions of safety everywhere. Even if things went a little south, he thought the assets alone would protect him.
And this slide right here, this is probably what sealed the deal. When you compared Hochschild Kohn to the big, publicly traded department stores like Sears or JCPenney, it wasn't even a contest. It was just dirt cheap. The valuation numbers, like the PE ratio, were way, way lower than any of its competitors. So think about it. Growing earnings, selling for less than its assets, and at a massive discount to everyone else in the industry. I mean, what could possibly go wrong?
Well, as it turns out, a whole lot could go wrong. The numbers on the page were telling one story, but they were hiding a much uglier truth about the business itself. And that beautiful bargain on paper was about to run head-on into the brutal reality of a dying industry. And what's so wild is that the data Buffett was looking at seemed to back him up. It showed that even though the total downtown shopping market was shrinking a tiny bit, Hochschild Kohn was actually growing its sales and stealing market share from the other Big Four stores. It looked like they were winning the war on their little block.
But here it is. This is the fatal flaw, the huge intellectual blind spot at the center of the whole deal. The market data they were looking at only included their three old rivals downtown. It completely ignored the real existential threat, all those new stores popping up in the suburbs where the customers were going. They were winning a battle on a sinking ship, totally oblivious to the tidal wave about to hit them.
The painful truth was this. Hochschild Kohn had no real, sustainable competitive advantage, no moat, as Buffett would call it later. If they spent a fortune to install a fancy new escalator, the store next door would just do the same thing a month later. This is where Munger's famous analogy came from. It's like being at a parade. You can stand on your tiptoes to try and see better, but then everyone else stands on their tiptoes, and nobody's view actually improves. You just all have sore calves.
And so, Buffett learned very quickly that he'd made a huge mistake. The lesson, which he learned firsthand, was that buying a so-so business, even for a ridiculously cheap price, is usually a trap. The lousy economics of the business itself just drag you down, no matter how smart you are. And you can just see how it all played out. While Buffett owned it, the business basically went nowhere. Then, as if bad business wasn't enough, they had bad luck. The riots in 1968 just made people flee downtown even faster. By 1969, just 3 years in, Buffett found a buyer and got out for about what he paid. But the downward spiral was already in motion. The big downtown store shut down for good in '77, and by 1986, the Hochschild Cone name was just gone.
And this chart, this is what shows you the real cost of the mistake. See, it wasn't about the money they lost. They basically broke even. The real cost was the opportunity cost, all the money they didn't make. During the exact same time, they were stuck with this department store, earning a measly 5% a year. The rest of their investments in the Buffett partnership were making over 30% a year. Hochschild Cone was like an anchor tied to a speedboat.
But all that pain, all that frustration, it led to what is maybe the single most important pivot in Warren Buffett's entire career. He boiled down the lesson from this whole disaster into this one legendary quote. He realized that digging through the bargain bin for cheap, mediocre companies wasn't the game. The real game was identifying truly wonderful businesses, the ones with a real durable advantage, and buying them to hold for the long run, even if you have to pay a fair price for them.
And you know, this lesson goes way beyond the stock market. It's a powerful idea for all of us. It makes you think, what's the fair company at a wonderful price in your own life that you might be tempted by? It's a reminder to always look past the cheap sticker price and focus on the real underlying quality. Because as Warren Buffett learned the hard way in Baltimore, in the long run, quality is pretty much the only thing that matters.
All right, today we're going to dive into one of Warren Buffett's most legendary and, honestly, one of his strangest early investments. It's a real masterclass in seeing this incredible value where literally everyone else just saw a massive, unacceptable risk. And it all happened right in the heart of the Magic Kingdom.
And you know, it's kind of funny, this quote from Mary Poppins, it just perfectly captures the cold, hard logic you needed for this story. I mean, think about it. Back in the mid-'60s, putting your money into the super sentimental world of Disney, that just seemed like the most muddled, emotional thinking you could possibly imagine.
And that really is the big question, isn't it? Why would a guy famous for buying these, well, kind of boring, predictable companies with massive margins of safety, why would he suddenly pour millions of dollars into a super volatile movie studio that, frankly, looked like a house of cards? It just seemed completely, totally out of character for him.
So here's how we're going to break this all down. First, we'll look at Buffett's truly bizarre bet. Then we'll see the pretty scary picture that the rest of the market was looking at. After that, we'll uncover the hidden magic that he saw. Then we'll do the math on this incredible bargain. And finally, we're going to ask the big question, did he sell too soon?
Okay, so let's set the stage. For someone like Buffett, a super disciplined value investor, this purchase just made 0 sense on the surface. It looked reckless, it looked speculative, and it was completely off-brand for him.
The facts themselves are pretty simple. In 1966, his partnership went out and bought 5% of Walt Disney Productions, and they paid $4 million for it. Now, you gotta understand, this wasn't some small casual bet. No way. This was a significant position, and it valued the entire company at just $80 million.
Okay, so to really appreciate Buffett's genius here, you first have to understand why the market was so scared. I mean, why was everybody so terrified of Disney stock back then? Well, let me tell you, the reasons were really starting to pile up.
It really came down to 3 huge red flags that were just waving in every investor's face. First off, on paper, the stock just wasn't cheap by the usual metrics. Second, the company had some, let's just say, serious corporate governance issues. And third, its main business, the entire movie industry, was in an absolute nosedive.
Yeah, the biggest, most obvious problem was what we call key man risk. The whole company, everything, its creative vision, its drive, all that Disney magic, it all seemed to live inside the head of one guy, Walt Disney himself. So the question was, what on earth happens to this company if he's gone? And nobody had an answer. And that was, well, terrifying for investors.
And it gets worse. On top of that, there was a pretty shady history of self-dealing. You see, Walt had set up this private company called Retlaw, which is just Walter spelled backwards, and it was basically siphoning profits away from the public shareholders. Get this,
Retlaw licensed Walt's own name back to his own public company. It even owned the Disneyland Railroad and the monorail, and it kept 80% of the profits from those. I mean, to put it simply, money that should have been going to shareholders was going straight into Walt's family's pockets.
And if all that wasn't bad enough, the whole industry was going through a complete disaster. Television was showing up in just about every American home, and because of that, weekly movie attendance just fell off a cliff. It plummeted by 70% from its peak. Box office numbers were in a total nosedive. The entire Hollywood business model was just crumbling. And Disney was smack dab in the middle of it all.
So, with all of that doom and gloom, how in the world did Buffett find the conviction to invest? Well, this is where it gets really interesting. This is where we see his contrarian insight, the hidden magic that the market was just completely, totally ignoring.
Buffett had this incredible analogy for Disney's film library. He called it an oil well, where all the oil seeps back in. He saw that movies like Snow White or the new hit Mary Poppins, they weren't just one-and-done hits. Nope. Every 7 years or so, a whole new generation of kids comes along, and you can just re-release the exact same movie and probably charge even more for it. The value? It was perpetual.
And this is Disney's secret weapon. It shows you that this company wasn't just a movie studio. It was a perfectly integrated machine. Think about it. A hit movie creates characters that go into Disneyland. Disneyland sells tons of merchandise. That merchandise then helps promote the next movie. It was this powerful self-reinforcing flywheel, and absolutely no other studio had anything like it.
And the numbers? Well, they back this up completely. The market was lumping Disney in with all the other struggling studios, but its performance was on another planet. I mean, just look at this. Disney's operating margin in '65 was almost 40%. Its competitors? They were lucky if they hit double digits. This wasn't just a quality gap, people. It was a chasm.
And then, of course, there was Disneyland itself. The market just saw this volatile movie business with a quirky little side project. But Buffett, he saw a phenomenal, high-return theme park that had a 10-year track record of growing attendance and growing investment. It was an absolute proven profit machine.
Okay, so how did Buffett put all these pieces together to see the real value? Well, it all came down to some simple, back-of-the-envelope math that showed just how absurdly, ridiculously cheap this company really was.
Okay, let's put this into perspective for a second. In 1966, Disney was building a brand new ride at Disneyland. You've heard of it, the Pirates of the Caribbean. Now, the cost for just that one single attraction was $17 million. Okay? Just keep that number, $17 million, in your head for a second.
Because at the very same time, the stock market was valuing the entire company. We're talking Disneyland, the whole film library, all the land they owned, the globally recognized brand, everything, at just $80 million. That is less than 5 times the cost of that one single ride. Like Buffett himself said, it was a joke.
And look, the disconnect gets even clearer when you do a simple valuation. I mean, a conservative sum of the parts analysis shows the film segment by itself was worth over $240 million. Then you add in Disneyland, the value of the film library, the land. You get a base value of almost $232 million. That is nearly 3 times what the market was asking for the whole shebang.
So Buffett bought it, obviously. But the story doesn't end there. Not even close. In fact, he sold his entire stake just 1 year later. Which, of course, brings us to the final big question: did he sell too soon?
So here's the timeline. In December of 1966, that key man risk we talked about, it became a reality. Walt Disney passed away. But the stock actually kept going up. So just 1 year after buying in, Buffett sold everything, cashed out for a nice, tidy 55% gain. Now, years later, Buffett would joke about this decision. He basically admitted that he'd left an astronomical amount of money on the table by selling when he did. And on the surface, it sounds like a classic textbook investment mistake. But was it really?
Well, here's the really counterintuitive part. Selling wasn't a mistake. Not at all. See, he took the money he made from Disney and he put it to work compounding at an even higher rate inside Berkshire Hathaway. Just look at the numbers. Between 1967 and 1995, Berkshire's book value grew at almost 24% a year. That easily beat Disney's stock price over the same period. He sold a great investment to fund an even better one.
And that right there is the ultimate lesson from all this. The game isn't just about finding a bargain. It's about opportunity cost. It's about the constant, relentless search for the absolute best place to put your capital at any given moment. Which really makes you wonder, doesn't it? What hidden assets, what obvious value is the market completely ignoring today?